Thanks for joining us today on The Close. I'm Marella Fernandez. Markets close in a half hour's time. Let's get to the stories we're following in the BNN Bloomberg newsroom. The Prime Minister Mark Carney and the Alberta Premier Danielle Smith signed a new energy agreement today. It aims to reduce some environmental conditions so Alberta can unlock more of its resources. It shows Ottawa's support for one or more new oil pipelines with a route that increases export access to Asian markets. Ottawa's also agreed to suspend some environmental policies for the province of Alberta and will adjust a tanker ban on BC's north coast if necessary. The Saskatchewan Premier played a role in getting this agreement across the finish line. The Premier, Scott Moe, will join us today at 4:20 p.m. Eastern Time. Canada's current deficit shrank in the third quarter. Data from StatsCan shows the deficit narrowed to just under $10 billion, led by a contraction of trade in goods as exports rose while imports declined. Investment income and trade in services also contributed to the overall narrowing of the deficit. Shares of Rogers Sugar edging higher today. The company reported profit and revenue in its latest quarter that came in above expectations. Rogers Sugar says results were driven by disciplined execution and consistent demand from customers. And it wants to expand its refining and logistics capacity in eastern Canada to support changing demand. The federal government and Prosper Canada are investing over $48 million in 97 community organizations that give financial support to those with lower incomes. The money will be shared over the next 4 years and will also provide services including tax filing, benefit assistance, financial education, coaching, and counseling. A look at where the TSX stands right now. It has moved up 66 points on the day, so set for another record close above 31,000, currently sitting at 31,247. And no American markets today. They are closed for the Thanksgiving holiday. Once again, American markets closed because of the Thanksgiving holiday, but the TSX rallied higher today, driven by gains in the technology and energy sectors. Our next guest says, or does, favor Canada and the U.S. over other markets for the next year. Let's go to Brent Joyce, Chief Investment Strategist, Managing Director at BMO Private Investment Counsel. Thanks for joining us today.
Good afternoon, Marella. Good to be here.
What is pushing the TSX higher and higher this week?
Well, certainly financials have been helping. We'll get reporting from all the banks next week. Energy's been a decent story here in Canada, but globally it's been a bit of a laggard. Year to date, the TSX has really been a market darling. You talked about the deficit story just a minute ago, and some of the inflows on the financial side certainly are going into Canadian stocks and bonds.
Okay, let's talk about whether or not, after the volatility that you saw last week, you are keeping any money aside.
Yeah, the last week's volatility, I think, is very healthy. Rotation from some of the sectors that have been the market darlings for the better part of a year and beyond. It's interesting on a day that's filled with football on U.S. Thanksgiving. We could talk a bit about some of the underdog sectors that have not performed in this 3-year bull market run. It's made us a little more constructive on the AI trade and the AI adjacent trade. They were getting ahead of themselves. I still think that you need to be discerning there. And what was very healthy through that is the behavior that we saw for things like Oracle versus things like NVIDIA. And investors being a lot more disciplined in looking at where are the profits going to come from, who can monetize this quickly, and who's got the debt. And that certainly was Oracle's story.
Okay, so do you feel then investors, as you say, are beginning to be a little bit more discerning and beginning to pick winners and losers?
Absolutely. And that really is part of our theme for 2026. It is a constructive view, but we're certainly realistic based on how far we've come with equity markets over the past 3 years. We're not in the camp that people are talking about excessive returns or exuberant returns. The market, I think, has been justified by a lot of earnings growth. And so we think about the areas of the market that maybe need to cool a little bit or grow into their earnings. There's been areas that earnings have well justified the advances in share prices, including some of the pockets within AI. Cautious not to straight line extrapolate some of those earnings expectations all the way, into perpetuity. We need to stay disciplined, and the market action over the past couple of weeks gives me comfort that that's what investors are doing. And then, as I mentioned, we can look at some of the dark horse sectors that have not participated. So this notion in the language of, it's been a rally in everything, I push back on that. It's been a rally in some things and not others.
Okay, so let's talk about we'll talk about first AI-related, because I'm wondering if you see more AI-related stocks getting pushed up next year. If so, where could that go? Before we talk about sectors that have widely been ignored. So what do you think for 2026 where AI will push?
Yeah, I don't think we are facing some sort of a calamity in the AI space. I do think it is a softening or a flattening of the trajectory for some of these businesses, a recognition, realization as to where the next leg goes, whether that is in the software space. We're also thinking about now, after 3 years, where is the deployment going to be? The innovation stage is ongoing, and there's been lots of excitement there. But really, for general purpose technologies, all the way back, to the steam engine and through on to the first internet revolution, the big uptick for society and for markets, equity markets, beyond just those that innovate, is how does that productivity get transmitted to everyday run-of-the-mill regular economy? And that really, I think, is the exciting story that stands for AI as we look to the future. And it's really a part and parcel of a broadening out as to the deployment of AI across regular businesses from what we might call the old economy today.
Okay, so let's talk about what has been sort of largely ignored and where you see perhaps some catch up for next year. What are the sectors that you see perhaps closing the gap in 2026?
Yeah, so we look back on the past 3 years. One is to remember the starting point matters. And so we did have a lot of areas of the market coming out of 2022 that were deeply depressed. Everything was pretty much on sale. We had a bear market in 2022. And so then it is a question today as to who's participated and who's maybe over participated a little bit, where there could be some pockets of stretched valuations, and then those who have not. And the list of those sectors that have not participated would be healthcare. Despite GLP-1s and all of the advances and aging demographics across the world, the global healthcare sector has posted about a 4% compound return over the past 3 years. That doesn't even keep up with the bond market. We've got things in there like energy. And certainly pipeline stories this week in Canada. The Canadian energy has performed better, but on a global basis, energy has been pretty flat for the past 3 years. Now, oil prices certainly have been down on the mat. Seems as though there is inflation everywhere except in oil prices. That's great for the consumer. We're not thinking about oil prices that need to be $20, $30, $40 higher for energy to perform. It's a question of if we see some reflation in the global economy next year, all the government spending, households stay reasonable, business spending that continues to flow, then $10 or $12 or $15 up in the oil price isn't going to upset the apple cart for inflation or the consumer, but it certainly would be a shot in the arm for the energy patch, and it is cheap on a global basis.
I do want to get you...
Another one that we can look at is real estate.
Okay, go ahead, sorry.
Yeah, the last one really to talk about there would be the real estate sector. And again, there are plenty of good reasons why these sectors have been downtrodden over the past 3 years. Really, the key is to ask ourselves, is that negativity about to lift? And by how much? And I think we're looking at a situation here where we don't need a lot of negativity to lift off of these three sectors in order to see the baton hand from other areas of the market that probably need to slow down and take a breather.
All right, I do have to leave it there. Brent, I'm out of time with you. Brent Joyce, thank you for your time. Brent's Chief Investment Strategist, Managing Director, BMO Private Investment Counsel. The Prime Minister, Mark Carney, and the Alberta Premier, Danielle Smith, have signed a new energy agreement today. The aim is to reduce reliance on the U.S. and get more of Alberta's oil to the coast. More in a moment. The big news today is that the Prime Minister, Mark Carney, and the Alberta Premier, Danielle Smith, have signed a new major energy cooperation agreement. It outlines conditions that need to be met for a new oil pipeline, or more than one new oil pipeline, to be built to the Pacific coast. For more on this, let's go to BNN Bloomberg's Lindsay Biscaya. She joins us now. Tell us more about the deal.
That is the big part, too. There's wording in there that does imply that there could be more than one pipeline, but we're focusing on the first one for now. So, yeah, this is kind of lays the pathway for a potential pipeline from Alberta transporting that oil over to the Pacific, over to Asian countries. But there's a number of conditions that have to be met in this MOU. Among those, Alberta has to sign onto an industrial carbon pricing agreement to lower methane emissions by 75% over 10 years. Alberta also has to extend the carbon capture incentive program, and then in return, the federal government will not be implementing a cap on emissions from the oil and gas sector. So again, laying out kind of the foundation to build a pipeline, and as you say, clearing the possibility of maybe more in the future, because in this MOU, it focuses on constructing, quote, one or more pipelines financed by the private sector with Indigenous cooperation. And that's the other part of this. The Prime Minister says if there's not a private sector proponent, then there will be no pipeline. So there's a lot of kind of things that have to fall into place here for this pipeline to come through. A tanker ban exemption is possible, too. Of course, that's been on the table for a while, but that would be the last in this. All those agreements have to be made in the MOU for the federal government to even consider a tanker ban lift at this point.
Yeah, another thing that would have to fall in line is the province of BC.
Yes.
The Premier has spoken against this, and he did speak a short time ago. What did he say?
Yeah, he's speaking right now. So he just called this a distraction from other, quote, real projects, like mining projects in the West that he says already have permits, already have approval. He says this is a distraction from that. He says the pipeline proposal has no project proponent. He says there's no private company that has stepped up to say that they will take the reins on this if it were to go ahead. So he, of course, very much against this because of many of the risks that would be posed if this project were to go through would impact BC if something were to happen. And then we've also got the Coastal First Nation, which, you need their support. The MOU says that, need the Coastal First Nation support for this project to go through. And at this point, the Coastal First Nation is saying that this is not enough for them.
All right, so we'll see what shapes up. Lindsay Biscaya with the latest on that. After the break, we'll hear from the Alberta Premier Danielle Smith, who spoke to us earlier in the day. Back in a moment. The Prime Minister, Mark Carney, and Alberta's Premier, Danielle Smith, signed an energy deal today, one that endorses a new oil pipeline that would go through British Columbia to the West Coast. The pipeline would open the export of oil to Asian markets. Now, the Premier of Alberta, Danielle Smith, joined us earlier today.
Alberta had 10 pretty bad years with some terrible laws that really dogpiled on our oil and gas industry, and quite frankly, looked to us like they were intended to shut in our major industry, which is not only vital to our economy, but to the economy of all of Canada. And with this agreement today, we see that the federal government under Mark Carney is prepared to take a different approach. And we're pleased to see that. The removal of the emissions cap on oil and gas, I think, will give additional confidence back to our energy sector so they can expand production. Ultimately, expanding production will make pipelines possible, as well as the elimination of the clean energy regulations applied to our electricity sector should result in reinvestment in natural gas energy production, which we hope will fuel an AI boom. So those are some pretty key elements to it, not to mention the commitment to work together on getting a new million-barrel-a-day pipeline to Asian markets and have a carve-out on the tanker ban to make that happen, as well as developing additional infrastructure for carbon capture, utilization, and storage. I mean, I had a big list of things that I wanted to address, and most of them have been ticked off.
Now, there's some things you have to do. The carbon price, industrial carbon pricing is going to jump to $130 April 1st. What kind of an impact will that have? Any concerns about that? And also the promise, your methane reduction by 75% relative to 2014 levels in 10 years. Are these achievable, and what kind of an impact will they have on business?
Well, a couple of things. I think that the stringency, how quickly that price will rise to $130 is something that is going to be negotiated and announced on April the 1st. You have to remember our starting point was that the prior agreement would have seen the price go to $170 by 2030, which I think both Canada as well as us recognize was too fast. So we'll have more negotiations on what that stringency looks like and what the ultimate price will be, and we'll make sure that our industry knows that in due course. on methane reductions, we've made incredible strides. We've reduced methane emissions 45% below 2014 levels. We did it 2 years early. And so in our emissions reduction and energy development plan back in 2023, we had set a target of being able to get to 75% by 2035. So the federal government has aligned around that target instead of the more stringent one they were looking at by 2030. What I think is important, and I mentioned this to the Prime Minister when I first met him, is that if we could align around a 2050 target, I think that we could really work together. And that's what we've done. If you look at the nations of the world, most of them have a 2050 target. China has a 2060 target. India has a 2070 target. And so this allows for us to have the incredible wealth of our oil and gas sector, using those dollars to develop the technology that is going to decarbonize many, many industries. And I think that's the right way to go.
And now, getting this built, the private sector interest, is it there? We haven't seen a lot of people jumping forward and saying, "Well, help." But is the interest there to help build this?
I would say that what we have seen, which is really encouraging, and I think it came from the federal budget where they indicated that the emissions cap would not be implemented. Enbridge announced that they want to expand their mainline 400,000 barrels. TMX announced that they wanted to expand their pipeline capacity by another 400,000 barrels. South Bow, which owns the old Keystone assets, wants a new 650,000 barrel a day pipeline. There's projects potentially for oil by rail. There's other ports that we're looking at, whether it's in Thunder Bay or whether it's James Bay or whether it's somewhere else on Hudson Bay. I think that what you're going to see is that a lot of that production will come on stream, which creates the demand for new pipelines. Our personal view is that the best opportunity for us to diversify our markets is to have another pipeline going to Asia. And that's what I'll be spending a lot of time doing in getting that to a point where we can put it on the major projects list. And we'll know then whether a private proponent will step forward. I hope they do.
And if there isn't private, will there be public money going into this?
The agreement says that we want a private sector proponent. And I agree. I mean, if we have to have the federal government build another pipeline, I think that's a failure of the exercise. The whole exercise we're going through is to restore investor confidence so that private sector dollars will be invested in these kind of nation building projects. That's my anticipation. That's my objective. We know that we as a government need to get it started because there was such a lack of trust on the part of the industry, many false starts on investing in projects where the rug got pulled out, whether it was on Keystone or Energy East or Northern Gateway. And so we believe that by being a partner with industry, that we can get it to a point where the private sector will have the confidence to complete the job. That's what we're working towards. Okay, now Enbridge and Trans Mountain are investing hundreds of $millions in measures aimed at increasing their appetites for the existing lines, with a recent TD Cowen report suggesting that they'll add the equivalent of 1 million barrels per day of shipping capacity. Is there even a need for another pipeline? I certainly think there is. I mean, I trust OPEC's expectations when you look forward into the future to 2050, that the world's going to need a minimum of 123 million barrels a day. I think we're at about 104 million barrels now. And we want to be a growing share of that growing market, especially since we're going to have the lowest carbon barrels. We think that'll be an advantage to those in Europe as well as those in Asia who value a lower emissions product. And so we know that we have a world where 700 million people don't have access to affordable energy, including electricity. And we've got to bring the billions of people on the planet who have a lower standard of living up to the same standard of living we all enjoy. That's going to take a lot of energy. And that's what I think the dual approach should be, that we've got to reduce global poverty at the same time as addressing issues of emissions. The language people are using now is that we're in a period of energy addition. There's going to be all types of new energy that come on stream, but I think oil and gas are still going to be the backbone. And with some of the decarbonization projects that we're investing in Alberta, I think that will give us an advantage in that market.
Good. Now, not everybody is for this. You've had David Eby, your next door neighbor, concerns about this. Indigenous groups have said it, yet there's supposed to be a co-ownership with Indigenous groups. How are you going to get them on board for this?
Well, we've had success with co-ownership with Indigenous groups in the past. We've got $750 million worth of projects, including pipeline projects, that have Indigenous ownership because we've given a loan guarantee. We have a capacity to go up to $3 billion worth of loan guarantees. The federal government has a similar type of program, as does British Columbia. So that's what we're beginning with, is saying that we want substantial Indigenous ownership along this line. And for my friend David Eby, he and I had a conversation yesterday. We're going to agree to disagree on certain things, but we're going to work work together on other things in the MOU that where we have a common interest. Expanding TMX, which he is supportive of, it's additional LNG development, which he, of course, is supportive of, ammonia, interties, as well as investment in nuclear, and perhaps even getting ammonia to the Port of Prince Rupert or one of the other ports. Those are the kind of things that I think we can work on together. And I'll continue engaging with Indigenous groups along a proposed future route to see if we can secure that Indigenous ownership stake. That's what we're working towards over the coming months.
Okay, and last question about the tanker ban itself. There's going to be exceptions, but there will likely be challenges. This could drag on for years, could it not?
I would say that there's a number of projects that are likely to go ahead very soon. All of the expansions that we were talking about and the optimizations, those could take place in the coming years. Obviously, getting the project on the major projects list is one step, but then there's a 2-year approval process that we would have to go through after that. And then there's all of the technical aspects of doing the construction, which of course could take years. But you've got to start somewhere. You have to start with the approvals. And that's why we're going to be investing a lot of time in figuring out the technical aspects, building the Indigenous equity stake, and then hopefully getting it on the major projects list. But the nice part is, with all of those 9 bad laws addressed to the satisfaction of the industry, those other projects are going to be able to go ahead. And that wasn't the case yesterday. The fact that we had a room full of about 150 business leaders who were pretty excited says to me that there's going to be many projects that are now going to be able to proceed. But
do you not see challenges coming to the lifting of or partial lifting of that tanker ban? Well, that would slow this down?
I can tell you one of the things that we were surprised by. I mean, the TMX construction dramatically reduced the differential on our Western Canada Select. And I think that demonstrated that having more than one customer is really important, not only to our province, but to the entire country. And that's why we've embarked on this to begin with. We know that being over-reliant on the American market has created some instability. Only having them as a customer blew out our differential and was costing all of us money. And we now know that there's an appetite in Asian markets. China has purchased oil from that line. Korea has purchased oil from that line, and they want more of it. And so we think that there's going to be an important market case to be made. And if we want to open up new markets, that's the place to do it. So that's why we're committed to doing it, not just for us, but for all of Canada.
The Alberta Premier there. Saskatchewan played a role in getting this agreement across the finish line. The Premier, Scott Moe, will join us at 4:20 p.m. Eastern Time today with his reaction to the announcement. Coming up next, the closing bells on Bay Street and Wall Street. Stay tuned for that. Markets are closed in the U.S. for American Thanksgiving. So at the TSX, we have Calgary Climate Week 2026, celebrating the launch of Calgary Climate Week 2026 from the Energy Transition Center in Calgary. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day today on Bay Street. The TSX end of the day only 16 points up, so it was up a little bit higher today. It's come down a bit, but still a new record close. So 31,196 is where we ended the day, up 22.8% over the last year. We'll have a look at the movers here in Toronto. No big, huge leaps and bounds, but almost a 3% move up by Go Easy. It gained $3.88 to $136.09, but it's down about almost 20% over the year. Let's move to MDA Space, which is a space technology company based out of Quebec. They gained 2.6%, up 62% to 24.18, but remained down 10% over the year. They lost a contract in the U.S. a few months ago, and that has hit the stock badly. Let's go to Bombardier. It moved up today almost 2%, gaining $4.50 to end the day at $233. It's up 141% on the year. It also had a change with a Moody's upgrade to some of its ratings in certain categories. And as mentioned, U.S. markets have the day off for American Thanksgiving, but they did all end in the green yesterday after that volatile week last week. So what's next? Let's go to Michael Greenberg of Franklin Templeton Investment Solutions. Thanks for joining us today.
Hi, Marilla. How are you?
I'm good. Investors have been waffling on AI lately. Do you think investors are being more discerning about where they're putting their AI money, or just nervous overall?
Yeah, I think there's obviously some nerves when you see these stocks doing what they've done, when you see some of the valuations. It does make it a little bit more challenging to foresee sort of the same strong level of returns that we saw going forward. That being said, our view is that we're probably still in the early innings of the technology, and that technology feeding its way through the economy, helping with productivity, helping with earnings, and helping with profitability. So, in some respects, I think there's still potential room. We would probably recommend not putting all the eggs in one basket and being a bit more diversified. But our view is that there's probably still some merit to that theme.
Do you feel like the race is beginning to narrow a little bit? There are some winners and some losers?
Yeah, I mean, if we look at it directly at the actual main tech names that are really directly implicated in AI and the investment cycle and CapEx, probably. But I think one of the things we're thinking about is, as this technology starts to diffuse to regular everyday companies, to different industries, to different sectors, it's going to be something that's going to start to have to be considered when you're doing your analysis on retail companies, on industrial companies, because those that are going to be able to implement this technology more efficiently than their peers are probably going to have a leg up as it pertains to costs, cost management, profitability, and these sort of things. So although maybe at the very, very tippity top, it's a little bit more narrow with some of these Mag 7 type companies, I think we are going to start to see it diffuse a little bit broader in the economy and within the stock markets.
Okay, so how do you see the AI story evolving next year?
Again, I think we're still going to need the picks and axles. We're still going to need the chips. We're still going to need the data centers. So, those that are directly involved there, should still be doing well. I think also when you start to look at some of the bottlenecks that could start to produce because of, the build out that we're seeing, there's going to be some indirect beneficiaries as well. And I think, that's where Canada probably could benefit, just given our natural resources. The electrification of the grid and the demand for energy is probably not going to go away. So I think there's going to be some indirect winners there, as well as, again, maybe broadening out within the corporate sector itself. So companies that are not necessarily directly related or direct AI plays, but that can implement that technology to do whatever they do a little bit better, a little bit more productively, that could be some opportunities, because some of those parts of the market, the valuations are a little bit less challenging. So there's potential for a little bit more upside, a little bit more broadening in the markets as well.
Are you surprised we haven't seen big bottlenecks yet, considering the pace of development?
It's hard to say. I mean, I think it does take time. I mean, a lot of these plans take time to implement. Also, I think what we're seeing is a lot of these, just taking data centers for an example, bypassing the grid. So you're seeing, record orders for gas turbines. You're seeing in communities where these things are being built, looking for ways to produce their own energy. I think it's still a little bit early. There's still a lot of build out to come. So I think we will see more and more of those bottlenecks. But also, I wouldn't, discount the technology improving, potentially the energy efficiency improving over the long term, where maybe it's not just a straight line energy demand that we're drawing today, but maybe there is some curtailment of that. That being said, I think it's still pretty clear that the plans as they are today are going to put some stresses on the energy infrastructure and energy supply, and could create some bottlenecks in the past, which again could be profitable for certain parts of the market.
Yeah, there also could and likely will be stresses on the labor market. How do you see that evolving?
Yeah, and I think if what you're referring to is potentially, AI taking over jobs and that sort of thing, that's clearly a concern. One of the things with new technologies is over the short term, there can clearly be some dislocation in employment, in jobs, in job demand, and job supply. But typically over the long term, when we see these types of technology advancements, they actually tend to create jobs. Now, that dislocation over the short term needs to be managed. I think it's one of the potential risks around the AI implementation that we're sort of expecting. It's unlikely if there's a lot of unemployment created because of AI technology influencing the job market, that people will take that sitting down, and that dislocation in the job market could show up in political regulations or other pushbacks. So I think it's not without its risk. I think it's clearly a really important theme in the market, really important investment theme. But again, we want to be wary of some of the challenges to the implementation of this technology and this broad theme, and hence, the comment earlier about not necessarily putting all of our eggs in this basket from a portfolio construction standpoint.
Okay, so that being said, should investors stay focused on North America?
We would say you definitely want to still maintain some North American exposure. Canada gives you that unique resource exposure, some interesting bank and finance exposures. The U.S., of course, innovation. But when we look broader, we do think there's some opportunities in places like Europe, emerging markets. Valuations are a little bit less challenging. Also in countries like Europe, Germany, for example, and others, we're seeing really massive fiscal spending to improve infrastructure, improve supply chains, improve productivity. And these are markets that are, have much less difficult valuations compared to, say, the U.S. Unlocking some of that valuation gap could mean some outsized returns for investors relative to some of the North American markets. So, we are suggesting that taking but not abandoning some of your profits from the U.S., where probably you've done quite well over the last number of years, and reinstituting some of that money into places like Europe, emerging markets, does make some sense. Again, diversifying outside of the U.S. and looking for some opportunities in those other markets is in our view, a good way forward.
When building a portfolio, then, what kind of framework do we need to adopt? Because things are changing so quickly.
I think we need to think about some of the big secular themes and some of the big secular risks. I think you still need growth in your portfolio. We do still think equities, whether it be public or private markets, are what you want to lean on for that growth. When you look at fixed income, we think with the higher yields and the somewhat steeper yield curves that we see, that starting yield level does give you a little bit more income and is still a good hedge against recession risk or growth risk. I think one of the risks that we do see coming forward in the next number of years is potentially a little bit higher inflation. So we also want to look at asset classes or tools that can help us manage a potentially slightly higher inflationary environment. That can be things like commodities. It could be private assets like real assets, private infrastructure, private real estate, that sort of stuff. So thinking about, how can we take advantage of upside in markets? How can we, hitch our cart to growth? But also, what are some of the risks that we see, and what do we want to have in the portfolio to buffer some of those potential risks as well? And again, have a much more sort of balanced experience with our portfolios.
Michael Greenberg, thank you very much for joining us on The Close. Michael is with Franklin Templeton Investment Solutions. Coming up next, as AI is likely to continue being the primary growth driver of the markets next year and beyond, we'll get more on how you can separate hype from value. Back in a moment. Choosing winners in the AI race can be challenging, but there might be growth potential in other areas of the market, not just the high-flying big tech companies. For more, we are joined by Mike Taylor, investment manager at Baillie Gifford's Global Alpha Team.
This is a general purpose technology. There's almost no industry that it won't impact ultimately. So finance is an obvious example, but healthcare. I even met a company last year that was using the technology in a sawmill to identify areas of the production line that were going to snag before they did so. So this is general purpose. I have heard it described as the invention of the printing press. The implications are so profound.
And where do you see, which industries do you see benefiting the most? You mentioned a few there. Which ones are you looking at and keeping a closer eye on to see what kind of a difference it can make?
What's really exciting at the moment is it's not clear just yet. At Baillie Gifford, what we're trying to do is look out over 5 years. So at the moment, probably the most profound impacts have been in the areas of coding, but I am really excited about the broader implications. What about the healthcare space? How can we develop our understanding of our own genomics to come up with new drugs, new therapies that will make lives better for sick patients across the world?
And I mean, we're starting to see that. It's the speed, I think, is what makes a difference with AI, isn't it? The speed at which these things can unfold.
Absolutely. It's remarkable. I mean, one of the trends we've seen over the last 3 years is that the chips that are powering this revolution, NVIDIA's GPUs, are getting more and more powerful. So whilst they're expensive bits of kit, the end customer is getting more and more performance per unit of cost spent on them. And let's not forget, this industry is still constrained. Customers cannot get enough chips. So they're still figuring out what to do with them. The implications over the long term are not yet clear, but they are going to be remarkable, in my opinion.
All right, let's stay with these big tech companies. Are there any concerns, any companies you see concerns with? You mentioned trying to meet demand is a challenge right now.
Yeah, it certainly is a challenge. I think that that is a result of the fact that NVIDIA is about the only company that can really design the cutting-edge chips, and TSMC is the company that just about the only company that can really make them efficiently. So there are a couple of bottlenecks. I think it's also fair to observe, however, that the big hyperscalers are putting a lot of money to work. They're not finding they're not being too restrained in their ability to deploy capital into this space. And I think that will, in the long run, benefit those companies as well as obviously benefiting their supply chain.
And what about Palantir? It's trading at a high valuation, just looking at this, but still demonstrating strong fundamentals. Is it still something for investors, or should they avoid that for now?
Palantir is not a stock that I am particularly close to, but I think whilst shares can go up, one of the most interesting and difficult things to get your head around in investing, I think something that we do well at Baillie Gifford, is that a share can go up, but it can get cheaper. And what I mean by that is if the share price has gone up, but the growth opportunity has expanded, or that company's ability to execute on the opportunity has improved, then actually it can be even better value even as the share price goes up. That's why we're still enthusiastic about companies like NVIDIA. But on Palantir, I'm afraid I don't have a strong view for you. Okay,
fair point. What about AI within emerging markets, and what are you seeing with that there? What kind of an impact is it having there?
What's really interesting about the current situation is that AI is accessible globally. So emerging market companies are able to access this technology. They're able to experiment with it just like companies in the more developed world. In the spring of this year, I was out in South America, and I met almost every company that I met there is using this technology. A couple of ways they're doing that. One example would be using it to do sales processes. So one business I met had reduced their sales staff from over 200 to a tiny fraction of that, and using AI to fill in the gap. Customer satisfaction levels actually increased when that happened. So it's being used across the emerging markets as well as the developed world.
And are the companies in those markets, are they doing it at the same pace as what we're seeing here?
I would say the more forward-thinking ones are. It's very easy to access the technology, right? Mm-hmm. It's probably fair to say at this point that most data center build-out is occurring in the Western world, so there's probably more capacity there. But if you are a forward-thinking emerging market company, you absolutely can access the technology.
And now you're talking about South America. Any other emerging markets that have caught your eye with that?
I'm a China bull at the moment. At Baillie Gifford, we're always trying to look out 5 years. We're saying what businesses are going to be meaningfully bigger in 5 years' time and what companies are going to dominate those industries. I would say I still expect the electric vehicle industry to be meaningfully bigger in 5 years' time. And at the heart of that are Chinese businesses. So, for example, I'm a big CATL fan. This is a company that makes the batteries that go into electric vehicles. It's got a market share of over a third, and it's a superior businesses to other players in the space. So their technology is better, their ability to package battery cells is better, and their ability to manufacture them. So what I am trying to do on the Global Alpha Fund at Baillie Gifford is look across the globe and say, what companies are going to be meaningfully bigger in 5 years, and what businesses will dominate those industries.
Mike Taylor is with Baillie Gifford's Global Alpha team. Coming up next, we have the Premier of Saskatchewan, Scott Moe, joining us to talk about the opportunity for new pipelines in this country. Back in a moment. We've been telling you about the new energy agreement, the memorandum of understanding signed by Alberta and Ottawa, which aims to get one or more private sector constructed and financed pipelines in this country. Saskatchewan has been involved in behind-the-scenes discussions on this, and the Premier, Scott Moe, joins us now with his reaction. Premier, thanks for your time today.
Thank you very much, Marilla.
Can you expand at all on your role in discussions that led up to this memorandum of understanding?
Well, largely, supportive of finding our way. First and foremost, I think to a table where we can collaborate from a provincial to a federal level, which really hasn't been that possible the last decade. In particular, when it comes from some of the prairie provinces and our federal government, and so to find that collaborative, that positive tone, to find that change in tone, quite frankly, so that this conversation can even happen, and so that the provinces can work very closely with the federal government to support the development of our industry, so that we can become, as the Prime Minister has aspired, a global energy superpower, and to create one of the strongest economies in the G7 nation. This is part of diversifying some of our production away from the United States of America, and it certainly is good for all Canadians moving forward. So very much an advocate, supportive. Credit to Prime Minister Carney, credit to Premier Smith for the hard work that they've done to find our way to today.
The Premier of Alberta spoke to us today and said she pretty much got everything on her list. She seems pretty happy. How would you characterize those discussions? Were they fairly straightforward? Was it easy to get to an agreement?
No, it took a lot of give and take, and that's why I say credit to, in this case, Prime Minister Carney, Premier Smith, and others as well, in really being open to being able to identify where we agree and where we can move forward, where we maybe have some challenges, and whether or not there's some opportunities for us to move forward. These are the decisions and the opportunities that we have as Canadians to determine our own destiny. Those discussions are not easy, and this is the first step in a lot of discussions, and some of them, yes, will be quite sensitive. But this is the first step in a long list of discussions that will really provide, I think, the opportunity for us to expand our economy, expand our opportunity, and really, as Canadians, make decisions that determine what this nation and what role we're going to play in global trade, in the global economy, and ultimately in our own energy and food security supply chains into the future. And so I think this is a good day. A good day, not just for Western Canada or even Alberta, but a good day for all Canadians. As you know, there's a clear call for private investment to both to build and to finance a project which will cost, billions of dollars. And I'm wondering if the changes that have been made, the changes by Ottawa to get rid of the oil and gas emissions cap that they had planned, removal of some of the greenwashing provisions, do you see that as enough to trigger private investment? Well, we'll see. I certainly see it as a tremendous step in the right direction to start to attract that private investment, in this case, into the energy industry. It's certainly, we didn't have the environment for that private investment to flow before. That's why we ended up building a taxpayer-funded pipeline in the TMX. So this certainly is a giant step forward in attracting that private investment. There may be more discussion that needs to happen. And I think it would be a shared investment, whether it be through energy companies or oil pipeline companies, or whether they be sharing that investment with communities along the route as well. And so now that those discussions can happen as to what type of environment we have now for private investment, do we need to continue to tweak it to some degree, and how do we include communities along the way in the economic opportunities that we may now be able to attain, which are above and beyond what we currently have. So, as I say, a good day for Canadians. Many discussions and a lot of work yet to happen. But today was a big step forward, both in the tone of discussions that we have at different levels of government between industry, and a big step forward in determining our own destiny as to what our nation is going to look like in the next number of generations. Premier, what does Saskatchewan get out of this? Oh, certainly, Saskatchewan will have we will have some oil that ultimately would be in a line like this, and so we advocate very directly on behalf of our oil producers that up in the northwestern part of our province that would be able to access some of this line indirectly. And I would say not just Saskatchewan, but all of Canada will benefit from a lower basis, which means a higher oil price. Indirectly, we'll benefit from more egress capacity into the U.S., which is largely where Saskatchewan's oil does find its way. Indirectly, we will benefit from a higher efficiency in the port operations and the port capacity that we have on the West Coast. And we ship 70% of our products out the West Coast to Asian and European markets and around the world. And we, continually have to work on the ability for us to increase our port capacity, our rail capacity out that West Coast. And so anytime that you can get a product like oil in a pipeline rather than on a train, it's going to increase our export capacity. So directly and indirectly, Saskatchewan can be a huge beneficiary, but I would say also are all Canadians. The bottom line of the federal budget will be have a stronger revenue line. Provincial budgets will have stronger revenue lines, as well as the opportunities to access these global markets for not just oil, but other products is going to be greatly increased. So as I say, credit to the folks that have changed the tone in the provincial national government's conversations in this space. This is a good day for us as Canadians.
I do want to get to this. The BC Premier, as you know, not on board. He's had a lot to say about this lately. Here's what he had to say a short time ago. We'll listen to this and I'll get your response.
The pipeline proposal has no project proponent. There is not one private company that has stepped up to say, if you build it, we'll buy it. If the approvals are in place, we'll build it. Not one. It has no route. Currently, taxpayers, through the Trans Mountain Pipeline Corporation, are funding the development of the route. Not only does it not have permits, it doesn't even have a route. But the third thing it doesn't have is something that the Prime Minister said he believed was core in the House, in the federal Parliament just recently, that First Nations agree and support projects before they will go forward through the Major Projects Office. And this project does not have the support of coastal First Nations.
Okay, so Premier, it will need Indigenous support. A lack of consultation got the Northern Gateway Pipeline project scrapped. So how will this be managed?
Well, I would say largely it was actually federal regulations that not only scrapped the Northern Gateway Pipeline, but also scrapped the Energy East Pipeline as well. And what we've seen today is a commitment on a number of levels, but part of that from the federal government is to right-size some of those regulations to make projects like this possible with private sector funding. Premier Eby, and I understand his perspective on things. I may not agree with all of it, but I do understand his perspective on a number of these pieces. What you will see, I think, in the days and months and years ahead is that you will see the private sector start to become interested in projects just like this, whether it be one of the two or three various pipelines that are being discussed here today. A route will be found, and as that route will be found, you will see engagement with communities, in particular Indigenous communities along the way. There will be partnerships, not approvals per se, but partnerships that certainly can be formed. Partnerships with economic opportunities for people that live in those communities. We've seen this very parallel work done in northern Saskatchewan in various sectors of the mining industry, where there are partnerships between the mining sector and local communities that are providing very real opportunities in very good careers for individuals that are living in those communities. And in fact, I would say that in Canada, that is a requirement of responsible projects moving forward, is that they are creating the environment for those partnerships that have very real benefits for people that live in the areas where these projects are taking place. That is the ethical way for industries to do business. And I think they most certainly realize that. So I think there's going to be some, challenging discussions ahead, but some exciting discussions for many communities, along any potential route for this particular project.
All right. Scott Moe, Premier of Saskatchewan, sir, thank you very much for sharing some of your time today.
Thank you very much, Marilla.
All right, we do want to get to this news just coming into the newsroom right now. Stephen Guilbeault is resigning from Carney's cabinet. He is currently Canadian, or was Canadian Identity and Culture Minister. He's going to stay on as MP. But remember, he was a big advocate for the environment before joining government, and he's doing this on the heels of this energy deal, which could see new pipelines built in this country. There has been no line that draws his resignation from cabinet to this announcement today, but it does have that timing we do need to consider. All right, coming up, high stakes for retailers in the holiday season. We'll hear from the CEO of Burberry and Bloomingdale's in a moment. High stakes for retailers this holiday season as Burberry and Bloomingdale's look to attract buyers who may not want to spend as much as they did in years past. Bloomingdale CEO says they're bringing back the golden age of the iconic department store, while the Burberry CEO says they're the only luxury brand of scale with a uniquely British heritage.
'Tis the season for holiday shopping, and despite U.S. inflation holding above historical averages for 4 years and tariff tumult upending global supply chains for the past 5, the CEO of Bloomingdale's, he says consumers are ready to spend.
Actually cautiously optimistic. The trend over the past few months has been amazing at Bloomingdale's. We feel pretty strong about our customers' feedbacks, about our partner feedback, about the current trend that we're experiencing, and we're building such a great event for this holiday season that we're convinced that it will resonate very, very well with the customer.
And he's not kidding. Bloomingdale's is betting big on the holiday season, from personalized stockings to a Labubu tree and even a visit from a very familiar face. All in an effort to reinvigorate the department store shopping experience with emphasis on experience.
This is what we're refocusing on right now, is bringing experiences. Not only great products, but really bringing experiences that create the conditions of relationship. People want to connect, and we want them to connect at Bloomingdale's.
The Bloomingdale's flagship store on the east side of Manhattan has for decades been one of the crown jewels of New York City retail. But behind that grand facade was a company struggling to adapt to the times. Now, after years of sales declines, Bloomingdale's, a division of parent company Macy's, has found its stride, posting 4 consecutive quarters of same-store sales growth heading into this holiday season. And Bloomingdale's has reason to be bullish. The National Retail Federation estimates that 44% of consumers will do their holiday shopping at department stores this year. And Olivier Braun, he's confident it will extend his company's rebound.
It's really about rebuilding the next golden age of Bloomingdale's. We heard a lot about Bloomingdale's in the 70s, in the 80s, where it was really the place to go. And actually, right now what we're trying to build is really recreating this destination, Bloomingdale's. And we're an icon, but we have to reinvent ourselves. It's also what Josh is doing with Burberry. This is what we're aiming to do at Bloomingdale's, with one key focus is actually bringing back customer experience, customer delight in our stores, and really based on building relationship, connections, etc. This is what is making us different.
The New York retail giant joining forces with the iconic brand and plaid, a relationship that goes back decades.
This is a relationship that Burberry and Bloomingdale's have had for over 70 years. So it's the perfect place to bring our timeless British luxury brand expression to all of Burberry customers and all of Bloomingdale's customers, and frankly, to all of New York City.
To celebrate that partnership in the spirit of the holiday season, Bloomingdale's has literally wrapped their flagship store in a giant Burberry scarf.
It was a little bit emotional, I have to say, seeing this uniquely British, uniquely Burberry, uniquely Bloomingdale's story come to life on the streets of New York City. There's only one New York. We are really thrilled to open our arms and wrap a scarf around New York City and bring a little bit of warmth and joy for this holiday season.
And since Joshua Schulman took over the helm of Burberry in July 2024, shares of the London-based brand, well, they've rallied 50% as the American-born CEO leans into the brand's Britishness.
There are many luxury brands that have wonderful, beautiful heritages, and they celebrate their heritage, whether it's Italian or French. But Burberry is unique because we are the only luxury brand of scale that has a uniquely British heritage.
Burberry, remaining true to its roots, is highlighting the products that cemented its status in the luxury space, while also branching into new directions.
Everyone knows and loves a Burberry scarf, which is the perfect gift for anyone in the family, around $520. But we have a range of products. You can buy a candle for $130 to one of our iconic made in England trench coats for $3,000. Burberry has always been at its best when it is a luxury brand with broad universal appeal. What we love about Bloomingdale's is they really share our values. And this is a brand that also has broad universal appeal.
A recent report by JP Morgan shows that consumer demand for luxury goods in the U.S. is largely held up despite the economic headwinds. The S&P's Global Luxury Index, which tracks 80 of the biggest names in that space, including Burberry, Prada, Dior, LVMH, that is showing no sign of slowing down.
The momentum that we're seeing didn't start for holiday. It started, months and years ago, and we just keep the pace right now. So we have new events, we have new marketing activation that are coming, we have new brands coming in the store right now, we have new ideas. So I think it's just a kickoff of what's coming.
And though Bloomingdale's has only just unveiled their 2025 holiday display, they're already looking ahead toward the future.
We already know what's going to happen in 2026. We're already working on what's going to happen in 2027.
Coming up next, we're exploring the impacts of the lumber and steel sector support announcement, what it means for companies moving forward. Back in a moment. AI stocks have been selling off over the last month because of fears of an AI bubble. The drawback has created an opportunity for investors to buy some stocks at a discount and increase exposure. We are joined today by Ryan Modesto, CEO, Portfolio Manager, I2I Capital Management. He zeroed in on his hot picks in this sector.
Providing GPU capacity to large AI companies and smaller AI companies as well. We like it. They're built a bit differently. We think they're a data center company that's built with AI in mind from the ground up, where a lot of their competitors are more have pivoted from Bitcoin mining into the AI data center place. So we kind of like the overall setup of Nebius, and their management team has built really large companies before. They're well entrenched in the tech sector, and we think they're well set to succeed in this space. The thesis here, though, really, I don't want to oversimplify it, but to keep it simple, it's just exponential revenue growth. I don't know if we've ever seen companies or a company or a group of companies that are growing revenues at the rate that this group is growing their revenues at, and at the scale they're growing it as well. In 2024, they did about $117 million in revenue. In 2026, they're expected to do $2.4 billion in revenue. For annual recurring revenue by the end of 2026, they're expected to do $7 to $9 billion in revenue as well. So large numbers. I guess the argument could be, well, anyone can throw out big numbers like that. How do you know they're going to act on it? But they're signing contracts to kind of back that up. A couple months ago, they signed a deal with Microsoft for $17 billion. And in the recent earnings, they also announced a $3 billion contract with Meta as well. And they said that contract would have been bigger. They just didn't have the capacity to service anymore at that time.
Your next idea is Ouster, and they are involved in sensors that can be used in robotics. Tell us what the attraction is here.
Yeah, so it's a bit of a robotics, a bit of an AI company. They do LiDAR sensors, and everybody, when they think of LiDAR, I think they think of autonomous vehicles. Ouster can do that in the future, but they're really focused on the robotic side of things. So think of automating your warehouse on forklifts, robotic arms, but also drones and things like that. So we think robotics in the next 1 to 3 years is going to kind of have its ChatGPT moment where everybody kind of says, whoa, these things are going to become real and they're going to be in our houses or wherever. And Ouster has the ability to kind of be the eyes for the robots that allow them to interact and see their environments. They're one of the first companies also to get government approval in the U.S. to deploy their sensors on military. So things like drones, perimeter security, things like that. And their main competitors tend to be cheaper foreign products coming from other foreign companies. And we think down the road, governments are going to crack down on this because there's real security issues, right? If foreign companies have LiDAR sensors all throughout your country, mapping out your surroundings and your every move, and Ouster's US based. So we think they're going to benefit in the future for their kind of geographic location as well.
That's interesting. So the Americans might be wary of Chinese vision equipment spreading through the country because the military, I guess, in theory, could be peeking through.
Exactly. Yeah. So always a risk, and just with heightened geopolitical tensions, we think down the road, in the next year or two, there will be some movements on that as well.
And finally, you've got a company for us called Invent Electric. They're an equipment supplier.
Yeah, so this is more of a traditional capital equipment supplier to the data center space, to the infrastructure space, doing cooling systems, things like that. And really, we like this company. They're just doing they're in the right place at the right time, and they're doing all the right things as well. So they have the obvious tailwinds with AI trends, data center. You also have the infrastructure onshoring and reshoring tailwinds that are helping them out. They've shifted their business more towards the infrastructure space in the last couple of years, and that's helping them increase their margins. They're growing organically in the mid-teens range. They're growing, when you add on acquisitions, 20% to 30% plus. Their margins are improving. They're buying back shares. They're increasing their dividends. And they're actually trading cheaper than most of their peers as well. They trade about 26 times forward earnings, and most of their peers in the space trade at, probably being generous here, but 30 times earnings or above.
It's amazing. I wonder, people supplying electrical equipment or expert electrical contractors in the States, they must be just swamped with business right now.
Well, that's a bit of it's a good problem to have, I guess,
yeah.
But it's a bit of the issue they're saying, right, where demand is far outstripping supply. And like Nebius as an example, they said, we have people lined up at the door trying to get access to data center capacity. It just takes time to build it out, right? And it's supply chain constraints and supply chain issues are really kind of a limiting function right now in the AI space, it seems.
Ryan Modesto, CEO, Portfolio Manager, I2I Capital Management. Up next, we're exploring the impacts of the lumber and steel sector support announcement, what it means for companies moving forward. Back in a moment. The Prime Minister has announced new support for the battered steel and lumber sectors, both, of course, hard hit by American tariffs. Mark Carney says we need to move our economy from reliance to resilience.
The core of the strategy in Budget 2025 is to unleash $1 trillion in total investments in Canada over the course of the next 5 years. That alone will increase our GDP by over 3.5%. or $3,500 for every Canadian worker, more than twice what's being taken from us. Now, to help get there, we must protect our workers and our industries who are most exposed to U.S. tariffs. That means in steel, aluminum, auto, and lumber sectors. Help them bridge to the future.
Let's bring in William Pellerin. He's a trade lawyer and joins us now to talk some more about this. Thanks for your time today.
Great being here.
So advocates for the lumber industry in BC, we spoke yesterday, say more than anything, a deal between Ottawa and Washington on lumber needs to be worked out. At this point, can you even see that happening?
We don't really see it just yet. I don't think there's any oxygen in the room for a lumber deal at this point. The parties are not talking, and from everything that we've heard, lumber seems to be a little bit below the priority to get steel and aluminum and perhaps an auto deal on the table.
Yeah. Loans are being provided for lumber companies. We heard that from the Prime Minister yesterday. You say wood products ecosystem is about to collapse. First, explain the kinds of products you're talking about, and if you've seen anything from Ottawa that benefits them specifically.
Yeah, so the wood products sector in Canada is much larger than we might think. It includes everything from the kitchen cabinet manufacturers to the furniture manufacturers to the panel manufacturers and everyone else that benefits from the mills, from the tree all the way down to the end consumer. A lot of these companies are now facing a very large tariff into the United States through those national security tariffs on things like kitchen cabinets and furniture. That are going to hit very, very hard. And we're seeing a lot of clients with red ink at the gross margin level, companies whose exports to the United States are in the dozens and hundreds of millions that are going to zero basically overnight. And so while there are some small loan programs that might allow for bridging or taking on more debt, there's absolutely need to get something in place to provide some relief for that sector, whether by a tariff in place in the same way as the government has announced for steel, but certainly a dire need that we're seeing in the coming days and weeks.
Yeah, my coffee table threatens me all the time, so I know what it's about. Let's talk about steel derivatives, a new tariff that Ottawa has put on from steel derivative products coming into the country. Is this a good idea? Will this work to support our industry?
I think the Prime Minister has certainly said that there's a lot of importance being attached to making sure that our steel mills are operating at capacity, that products are made in Canada. And so on top of restricting foreign supply from a number of countries on the steel products themselves, we're now adding this 25% to what you describe as the steel derivative list. The full list has not yet been published, but it includes things like doors and windows, fasteners, which are screws and nails, various prefabricated structures, steel and iron cloth products, and all sorts of other kind of goods that are made with steel. So again, this is a highly controversial move because, again, it will add costs on Canadian consumers. Just adding a tariff, we've been saying that to the United States, that a tariff is a cost on consumers. But in this case, the Prime Minister felt that it was warranted to make sure that the steel mills are operating and the steel ecosystem is able to sell more domestically by putting a pause on a lot of those imports.
Yeah, I guess we create that hole, of course, where if we're not making enough of those fasteners, for example, the people who use the fasteners are going to have to pay more for the ones they're getting out of the U.S. And I'm not sure that our industry can transition fast enough to make some of that supply in a shorter period of time. Okay, there's also going to be limits on imports of steel, even with our trading partners. Will this be an initiative you think that'll bolster steel at home?
So the quantification there that the government has provided is that through these additional measures, they're looking at increasing Canadian steel mill production by about $1 billion, which would be a significant sum. But again, highly controversial, very, very much welcomed by the steel industry in the country, by the steel producers, but certainly one that will create some supply shortfalls in the short term and also anger our trading partners. And that's an important consideration also because, as we know, the government is very keen on adding new trade deals with a number of other countries in order to diversify our sources of exports, right, to grow our exports to outside of the United States. But this measure is a really interesting one because what it does is it imposes a cap on the amount of steel that we can bring in, even from our free trade partners. So there's going to be a cap based on 75% of 2024 volumes from our free trade country partners. And above that cap, so limiting supply from a historical base, there will be a 50% tariff. That's been in place since the summer, but it was previously capped at the actual level of prior imports being 100%. And so now we're bringing that down to 75% of historical volumes, meaning that the domestic industry will be able to make up that shortfall. That's the hope, at least. But in practice, it means that we're going to accept less steel, including from our free trade partners.
We haven't seen a whiplash reaction from Washington. Quite often we do every time some new tariff initiative is announced in this country. Do you think that we are bound to see some sort of reaction? You sort of touched on that before.
I think the reaction is going to come from other countries than the United States. I think the European Union, I think Japan, I think Korea have a lot to say about these measures because that's whom we're restricting supply from. The United States might actually like this measure in some ways because we've excluded them from the application of that tariff specifically, basically to give our industry a bit more breathing room without poking the United States in the eye too much.
Got it. I do have to leave it there, William. I always appreciate you joining us on The Close. Thanks for your time.
Always a pleasure.
And thank you for joining us on the show today. We'll see you back here again tomorrow.